Welcome back to the deep dive. Today, we're plunging into the latest China Basic Materials Monitor report. This is the July 2025 edition, hot off the press from Goldman Sachs, released July 20th with prices current as of July 18th. Our mission, as always, is to cut through the data, extracting the most critical insights on demand, supply, inventory, and pricing trends across China's core industrial commodities. We want to give you a sharp, informed perspective, in record time so you can stay ahead. So from this comprehensive analysis, what's the big headline? What's the main story here?
Well, the report paints a pretty clear picture. We're seeing demand weakening across the board, while supply adjustments are still sort of struggling to really firm up. As of mid-July, end-user order books did show a mild month-over-month pickup. Let's call that MOM for short, but, and this is crucial, these are still at historically low levels.
Okay, low levels despite a small pickup. Let's unpack this weakening demand bit. Where are the key pressure points? What sectors are feeling it most?
Yeah, good question. We're seeing infrastructure construction weaken quite significantly. There's a visible deceleration in new project starts. Feedback from, cement producers and construction dealers points to persistent funding constraints. And now, apparently, even more stringent payment requirements are biting.
Ah, the funding issue again, plus tighter payment terms. Okay. What else?
Metal demand has also softened. We're seeing signs of inventory actually building up in the mid-supply chain. And it isn't just one single factor here. It's really a combination of things. You've got your typical seasonal softness, sequential correction happening in domestic solar demand, which is interesting, plus a pretty disappointing trend from the grid sector, and very likely a tide change coming in copper exports.
So a confluence of factors hitting metals. And on the supply side, then, is the market responding with significant production cuts? Or is it still grappling with that oversupply?
Well, the determination on supply adjustments is actually quite mixed. It hasn't really firmed up. For instance, steel production cuts are starting, but the targets vary wildly across different producers. It's not uniform at all.
Right. Heterogeneous targets, the report calls it.
Exactly. And we're also seeing a continued absence of local government commitment to eliminating excess cement capacity. That's a persistent issue. Marginal coal miners, perhaps surprisingly, seem reluctant to cut production, even with poor prices.
Really? Holding on despite low prices.
Yeah. And then in the lithium market, which we know is already oversupplied, unexpected mining license approval inspections have added an interesting twist, sort of temporarily tightening some supply right when you wouldn't expect it.
That gives us the qualitative picture, the feel for it. What about the quantifiable impact on demand? Can we put some numbers to this slowdown?
Absolutely. The high-frequency data from the report suggests current Chinese demand is notably lower year-over-year YoY. For sectors like cement and construction steel, demand is down by 7% to 11% YoY. That's quite substantial.
7 to 11%. Okay.
And for copper, flat steel, and aluminum, we're looking at a 1% to 10% decrease YoY.
1 to 10%. So still down, but a bit more varied there.
Exactly. These aren't just minor dips. They definitely signal real headwinds for these sectors.
And amidst these dynamics, how are margins in pricing faring? Is everyone getting squeezed, or are there differences?
There are differences. In the few weeks leading up to the report, we did see some pockets of improvement. Margins in pricing actually improved for steel, coal, and lithium.
Okay, those three saw improvement.
But the picture is quite different for cement, aluminum, and copper. All of those saw weaker margins in pricing during the same period, so real divergence.
Here's where it gets really interesting for me. The report relies heavily on proprietary surveys and channel checks, basically, talking to people on the ground. What are these checks telling us about forward order books and inventory levels as of mid-July? This is where the granular insights often emerge, right?
Precisely. And they do offer some nuance. Let's break down what those channel checks reveal. For forward order book trends, producer feedback does indicate that mild month-over-month pickup I mentioned. But again, it's crucial to remember this is starting from very low historical levels.
Right, context is key.
So specifically, nearly a third, 31% of respondents reported a MOM improvement in July for downstream sectors. Now, that is a notable jump from just 14% in June.
Okay, so more than double.
And conversely, those expecting a MOM decline dropped significantly from 36% in June down to 25% in July. So you see a shift in sentiment there, but perhaps not a robust recovery just yet.
Understood. And for basic materials themselves, the actual commodities, did the order book trend follow that same pattern?
It did, broadly. The order book trend for basic materials also showed a pickup. Roughly 30% of respondents expected a MOM improvement in July. That's up from 23% in June. And those anticipating a decline dropped sharply from 51%, quite high. down to just 24% in July.
Okay, that's a big drop in pessimism.
It is. But if we dig into the specifics within basic materials, the picture gets more nuanced, more mixed. Coal, for instance, saw a really strong improvement expectation, hitting 100% up from 75% in June. Containerboard paper also had a robust 75% improvement expectation, jumping from 25%.
Wow. Okay, strong moves there.
But then foundational sectors like steel showed zero improvement expectation, down from 13% in June. Building materials also saw a decrease in improvement expectations, down to 17% from 29%.
So steel and building materials lagging significantly.
Correct. Base metal fabricators and traders showed just a modest 10% improvement, up from nil. So it tells us this pickup, this recovery, is quite uneven across the board. Overall, though, 78% of respondents noted normal seasonal patterns, while a smaller group, 16%, observed weaker than normal seasonality, and that was primarily noted in copper.
That's a great distinction, a general trend perhaps, but masking these really important sector-specific challenges. Okay, so shifting to inventory levels then. Producers and users. Where are things stacking up? Are we seeing gluts or lean stocks?
Yeah, the mid-July inventory survey reveals some key distinctions here too. We're seeing above normal inventory levels for coal, reported by a net 44% of respondents. Also finished steel at a net 15%, and paper and building materials net 17%. These are generally stable or even moving up, suggesting potential oversupply issues there.
Okay, coal, steel, paper, building materials, potentially high inventories. What's normal?
Inventory for iron ore, met coal, copper, and alumina are reported at normal levels and largely remaining stable. So kind of balance there.
Got it.
And finally, inventories are actually below normal levels for aluminum, reported by a net 13% of respondents.
Oh, sir.
Also for old corrugated containers, OCC, that's at a net 25% below normal and actually moving down further.
Interesting. OCC moving down.
Yes. And overall downstream products are also slightly below normal, net 6% and stable. So it's quite a diverse picture, highlighting different supply-demand balances across commodities. Very diverse indeed. Okay, so we've got these broad brushstrokes, the channel check insights. Now, let's zoom in, as you said, and see how these dynamics are playing out in some key sectors. Let's start with steel. It's often seen as a bellwether for China's industrial health, right?
Absolutely. It often is. For steel, the forward order books for most mills were actually down month over month in July. This aligns with typical seasonality, but it's still down. High-frequency data shows construction steel demand declined significantly by 11.0% year over year. Flat steel demand was also down by 3.0% year-over-year.
11% for construction steel? That's a big hit.
It is. Mills reported weaker order books specifically from auto, appliance, and unsurprisingly, the property sectors. Infrastructure and exports, however, remain largely stable. And interestingly, many mills are maintaining pretty elevated annual export targets despite maybe softer domestic demand.
Trying to push volume overseas then, what about supply and inventory? On the supply side, over 80% of the surveyed mills did initiate production cuts in July. They were planning anywhere from 1% to 16% lower MOM production. But, as we discussed, full-year cut targets remain mixed. Most state-owned enterprises, the SOEs, seem to be aiming for modest 1 to 5% year-over-year cuts, while others are less clear on their plans.
So cuts happening, but maybe not deep enough or widespread enough yet.
Potentially, yes. Finished steel product inventory at the mills sit at 4.3 million metric tons as of July 11th, which was stable month on month. So inventory isn't drawing down rapidly yet.
And pricing. You mentioned earlier steel saw some improvement.
That's right. In terms of pricing and margin, the domestic unit gross profit for steel did improve, MOM. It was between 100 and 160 renminbi per ton Armenton, up from 71.30 Armenton in June. Export profit, however, was slightly lower, MOM, around 160, 170 Armenton.
Okay, so some domestic margin relief, but maybe not sustainable if demand stays weak. That's a lot of mixed signals in steel. What's the situation like for coal? Is it mirroring these struggles, or are those different seasonal dynamics playing out, offering a contrast?
Coal is actually showing a different picture right now. Producers reported demand mostly up month over month in July, which is consistent with normal seasonality.
Driven by summer heat, presumably.
Exactly. Daily power consumption increased, MOM, due to the hot summer, aligning with or even exceeding normal seasonal patterns. Coal demand from non-power sectors like steel and cement was described as being at an average level in July.
And supply and inventory for coal.
Inventory at major independent power producers was above 25 days worth. Now, that's actually lower, MOM, in terms of inventory days, because the consumption rate, the daily burn, is higher seasonally.
Ah, right, the denominator changed.
Precisely. Safety inspections in Shaanxi and Shaanxi seem to have a pretty muted impact on overall production. And while profit for the marginal, smaller producers is indeed challenging, as we noted, very few have initiated significant production cuts. The large coal producers are generally maintaining their annual targets. So supply is holding up.
Resilience on the supply side there. How about pricing?
For pricing and margin, domestic thermal spot prices rebounded by about 4%. The contract coal price was at 666 RMston, which is about 30 RMston above the current spot prices. Non-power downstream producers, like cement and paper plants, were paying between 620 and 650 RMston for coal. That's about 1530 RMston higher month over month.
So coal is showing some seasonal strength, benefiting from summer power demand. Okay, how are things looking for cement then? That's closely tied to construction and infrastructure, which you said were weak.
Yes, and the cement sector picture reflects that weakness clearly. We're seeing weaker margins and demand there. Daily shipments for cement, ready-mix concrete, RMC, and also glass producers were mostly flat to down month over month by mid-July, which aligns with normal seasonality, but again, starts from a low base. High-frequency industry cement shipment data showed a 7% lower year-over-year figure for the month of July 11th. Major producers reported 7% lower YoY shipments.
And the funding issue is key here.
Crucially, yes. The channel checks confirmed there's been no easing in funding for infrastructure projects. Construction pace remains depressed. New project starts were weaker sequentially across many regions. Project start rates actually trended lower during June-July, ranging from 30–32% compared to around 40% previously.
That's a noticeable drop in activity. Any supply response?
Some adjustments. Planned production suspensions were maybe 1 to 5 days longer in Hebei and the Northeast regions, but mostly flat elsewhere. And while there are ongoing discussions about anti-involution, essentially, efforts by major producers to coordinate and prevent price wars.
Right, trying not to undercut each other to death.
Exactly. But despite those talks, no additional widespread supply cuts had materialized by mid-July. Inventory levels range from 50–74% full, which is slightly lower than the 64–77% range a year ago, but still quite high.
And the impact on price and profit must be significant.
It is. By mid-July, we saw price declines of 525 RMston in key regions like the YZD, GDGX, and Hebei compared to the previous month. Unit gross profit is estimated at a very thin 2050 RM/ton in mid-July, down from an already low 2557 RM/ton a month prior. So margins are really compressed.
Paints a picture of clear weakness in cement, directly linked to that construction slowdown. What about the aluminum market? Is it facing similar headwinds, or is it a different story?
It's a bit of a mixed track for aluminum and alumina. Channel checks with aluminum fabricators indicate their order books were mostly lower month over month, which they said aligned with normal seasonality. But the high-frequency data shows current end demand for aluminum is running at 10.3% lower year over year for July.
10% lower YoY. That's substantial. What's driving that?
Fabricators specifically cited seasonally weaker order books from auto, solar, construction, and also food packaging foil. Grid order books also weakened MOM, reportedly due to a slowdown in state grid purchases. And that solar demand weakness we mentioned earlier, it seems to have weakened further for aluminum. Expectations were for a 10% MOM drop in solar module production. Solar glass producers also saw order books weaken 10% MOM, and one domestic solar module producer reported a significant 30% MOM drop in orders for July.
Wow, so we're really pulling back sequentially then. How's supply looking?
As of mid-July, industry capacity utilization for primary aluminum was high at 96%. Alumina operating capacity actually increased by 4 million metric tons, reaching 92 million metric tons over the past month. That was mainly due to newly added and restarted capacity in northern China.
So supply potentially growing into weakening demand. What about margins?
The aluminum spread, a proxy for profitability, was 5,694 RM/ton. That's 4% lower month over month. Unit profit for marginal alumina producers, the higher cost ones, was estimated at a pretty low 30–70 RM/ton.
Okay, so challenges there too, especially with the solar pullback. Finally, let's talk copper. Given its broad use across so many industries, what's the outlook there? Is it also feeling the pressure?
Copper is definitely experiencing weaker demand. And, importantly, its export trend shows a potential reversal, which poses a negative risk ahead.
Export trend reversing. Explain that.
Well, traders predict that refined copper exports are likely to decrease or maybe even reverse into imports, mainly because the price gap between the London Metal Exchange, the LME, and the Shanghai Futures Exchange, SHFE, has narrowed significantly. The arbitrage window is closing or gone.
I see. So that export outlet might disappear. What about domestic demand?
Channel checks with major fabricators indicate order books were flat to down MOM, which they noted was weaker than normal seasonality for copper. High-frequency data suggests current end demand for copper is about 1% lower year over year for July, so slightly down YoY. Fabricators pointed to continued weak demand in July, even though the price did come down a bit, about 2,370 RMB from its peak. This weakness is driven by that solar correction we keep mentioning, seasonal softness in appliances, and basically no growth from grid demand.
That solar impact seems quite sharp for copper, too.
It does. One major power cable supplier told the survey team its solar-related order book had almost gone to zero in July, after already falling 50% in June. And they're seeing rising cable inventory.
Ouch, gone to zero.
Yeah. And most fabricators seem to believe a copper price closer to 75,000 RMB is a more accepted level downstream to stimulate buying. That's about 6% lower than the March 2025 level mentioned in the report context.
So price needs to fall further to find support. How about supply and inventory?
On the supply and inventory side, Chinese copper inventory that includes stocks on the SHFE in bonded warehouses and social inventory, it remained mostly flat month over month as of July 11th. Now, flat inventory sounds okay, but it's actually worse than past seasonal patterns where you'd expect a drawdown this time of year. So it indicates inventory is building relative to seasonal norms.
Right, relative weakness.
And scrap availability seems okay. Scrap charge rates at smelters remain high at 15% in May. But despite very low treatment and refining charges, the TCRCs, which hurts smelter profitability, Chinese smelters currently have no plans for production cuts, according to the report.
Still no cuts planned despite low TCRCs. Interesting. Pricing.
By mid-July, the physical premium for domestic refined copper did increase to 95 RMB, up from 35 RMB a month ago, suggesting some tightness in immediate physical supply perhaps. TCRC remained negative at US 44 RMB, flat MOM in headline terms, though it effectively increased by about US 13 port and MOM if you adjust for the income smelters get from higher sulfuric acid prices, a byproduct.
Okay, a very detailed picture across the board. That's a lot of granular data. So, for you, our listeners, what does all this mean? We've unpacked a significant amount here. Let's try to synthesize this further now with a few key questions. Really connect the dots on the bigger picture.
Indeed. Let's try and draw out the crucial implications from all this data.
Okay, so given these mixed signals, we've heard pockets of strength, broad weakness, uneven supply responses. What's the single biggest overarching takeaway for the overall health of China's basic materials sector right now? What's the fundamental issue at play?
That's a really key question. I think while the report does show those end-user order books picking up slightly month over month, it really appears to be just a mild seasonal bounce from what were already very low levels. It doesn't look like a robust fundamental recovery yet. The underlying demand, particularly in those crucial areas like infrastructure and property, remains genuinely weak. It's facing structural headwinds, these persistent funding constraints, and the increasingly stringent payment requirements we discussed.
So the demand side is structurally challenged.
Right. And I think the core challenge for the sector isn't just insufficient demand, but it's also the inconsistent and often reluctant response from the supply side. We see this clearly in steel, cement, and coal, where production cuts are either mixed across players, completely absent, or producers are simply unwilling to cut output despite poor prices.
So demand is weak and supply isn't adjusting fast enough or uniformly enough.
Exactly. It means that issues of oversupply are likely to persist in many areas, even if some specific commodities, like steel, coal, and lithium, have seen these temporary margin improvements due to other factors. It really suggests that without more coordinated and decisive supply reductions across the board, a broad-based recovery for the sector remains quite challenging.
That makes sense. Now, you mentioned that divergence earlier. Steel, coal, and lithium prices and margins improved, while cement, aluminum, and copper were weaker. What really explains that split, and how sustainable do you think these contrasting price movements are?
Yeah, that divergence is intriguing. What seems to be happening is that the price improvements in steel, coal, and lithium are driven more by very specific supply-side dynamics or, unique market quirks, rather than reflecting any broad, robust rebound in overall demand.
Can you give examples again?
Sure. Steel, as we said, has seen some initial, albeit mixed, production cuts. Lithium benefited from those unexpected mining license inspections that suddenly tightened supply, even though the market is fundamentally oversupplied. And coal simply saw that clear seasonal demand uplift from the hot summer weather boosting power generation.
Okay, specific drivers for those three.
Right. Conversely, cement, aluminum, and copper are still grappling directly with the persistent demand weakness. Cement from construction, aluminum from solar and grid slowdowns, copper from those same areas, plus the potential reversal of export trends adding negative risk.
So the weakness in those three is more demand-driven.
Primarily, yes. And the sustainability of the price improvements in the first group. It really depends heavily on whether the supply side commits to firmer, more widespread production cuts going forward. As the report notes, that commitment is currently very mixed and heterogeneous, so without that firmer supply discipline, those price improvements could easily prove fleeting.
Right. Could be temporary boosts rather than a turning point. Okay, final question. The report implicitly touches on both traditional manufacturing and advanced manufacturing as demand drivers. How are these two broad segments performing relative to each other based on this data, and what implications does that have for future materials demand?
That's another really important point, highlighting the structural shifts happening within China's economy. On one hand, you have traditional manufacturing, think white goods, automobiles. The latest reported official data periods showed positive year-over-year output growth there.
Okay, traditional sectors still growing YoY in official data.
Yes. But on the other hand, you have advanced manufacturing. Areas like solar installation, new energy vehicle output, they still display very high year-over-year growth percentages, impressive numbers. However, this report's channel checks are showing clear signs of a sequential month-over-month correction or slowdown.
Ah, so the YoY growth might mask a more recent mom cooling.
Exactly. The report specifically calls out disappointing trends from the grid sector, and that significant month-over-month drop in domestic solar-related order books for both copper and aluminum that we discussed. This implies that while the overall annual production figures might still look robust in some of these advanced sectors, the month-over-month slowdown indicates a potential cooling, maybe rebalancing, happening right now.
And the implication for materials demand going forward.
The implication is that while these new energy sectors are indeed growing structurally, they might not be growing fast enough right now, or their current correction might mean they can't entirely offset the continued significant weakness we're seeing in the traditional heavy industries like property and infrastructure. It sets up a more nuanced and potentially challenging landscape for basic materials demand in the coming months. Growth is likely to become far more selective, depending on which end markets a material serves.
That's a critical insight, the divergence, not just between materials, but between their end markets too. So wrapping up, what does this all mean for you as you navigate these markets? It's clear that understanding China's basic material sector right now requires really digging into this granular data, discerning between what might just be fleeting seasonal upticks and what represents more fundamental shifts in demand or supply. The interplay of weakening traditional demand, these very mixed supply responses, and a potential rebalancing or cooling in some emerging sectors creates a complex but absolutely crucial investment landscape to understand.
Indeed. And knowledge, as they say, is most valuable when it's understood and applied. This report, despite the complexities, offers invaluable insights into the real-time intricacies of China's industrial backbone.
Absolutely. So as you consider these dynamics, perhaps ask yourself, given this detailed picture of demand, supply, and inventory, which specific materials or perhaps which companies within those sectors are truly poised for a sustainable rebound versus those that might face a deeper correction the second half of 2025? It's a vital question, food for thought for every investor watching this space. Until next time, stay well informed and keep digging deeper.